Go. We're live. It came through. All right. Michele Kreinheder, real estate agent at Compass in Long Beach. I'm sitting here in the meeting room at the second and PCH Mall. I love coming to work. It's such a great place to come. And today I'm really excited because I have a CPA. How awesome is that? Just going to bring her right in now. I'm going to introduce her. Hi, Jacqueline.
How are you?
I'm good. Let me put your name up here so they know. Yeah, there you are. Jacqueline Swig, is that how you say that?
Swag.
Swag. I knew I was saying it wrong. Just swag.
You have to say Y when you say it. So it's Zweig.
Swag.
Swag, yeah.
My husband and I, we've been using Swag Associates. I would bet you'd say it's over 20 years. It's just one of those things, time goes by. But, just want to introduce yourself and tell a little bit about yourself. That'd be great.
Well, I'm Jacqueline Zweig. I am a CPA. I am the daughter of a CPA. So I was brought up in the tax world. I ended up going to college to get my accounting degree and my finance degree while I was doing taxes, working for my father. And my father had another business partner that he was with for 30 years. His partner retired in 2017. So I became partners with my dad, and we renamed our firm Zweig and Associates, the formerly Born and Zweig. So we're a small, we're a family practice. We have a lot of family members working for us now. We have a staff of up to about 20 people. So we do tax, bookkeeping, payroll. I am a certified financial planner, a CPA, and I'm also an EA, an enrolled agent. So I got my CPA back in right after college. Then very next year I got my CFP. So I was only 23 years old, I believe at the time, 24 years old when I had both of those.
So that's what the CFP is, that financial planner. And what is the EA?
Enrolled agent. So enrolled agent is basically somebody who's a tax expert who is registered with the IRS. So it's a federal designation, whereas the CPA is a state license. So CPA, you pass a state exam. Each state has its own exam, whereas the EA is a federally recognized designation. So the only thing it really benefits me in that is that if I ever move out of state, I can still represent clients in front of the IRS without having to get my CPA in that state. Although I don't plan on leaving California, I just got it for the sake of it, just to see if I can, to be honest.
Okay. Yeah, you guys have grown. I mean, I think I haven't seen you in a long time because of COVID, right? And you got everything pretty much online. But yeah, and I know when we sat down and you had just joined your dad, you were like, "We're going to grow the business. You're doing good. You're growing your business, huh?"
Yeah. So things have just been doing really well, and I think we work really well as a team and work on client, retention and stuff like that. So we've definitely grown and trying to refine. With COVID, we had to adjust and go more remote, and it works better that way. So I like it, and it helps me help more people anywhere because I can be way more efficient with my time. I remember the days when I had 12 appointments back to back coming into my office. And it would take up the whole hour each client. So then I could only help 12 people in a day. But with working remote, I can do things a lot more efficiently, I feel, and helps me be productive. So
yeah. It's worked for me. I mean, I upload the stuff. If I have a question, we just go back and forth. It's fine. I enjoy it as much as you probably do.
Yeah, and I still do phone meetings and Zoom calls, so we still get all the value out of the service advice. So.
Yeah. Perfect. Okay. So the question I'm going to start with, because I found from talking to so many people, I'm not the only one totally confused by the $250,000 or $500,000 capital gain. What do you call it? When you sell your house and you don't have to pay capital gain on that $500,000 if you're married. So can you just like expand on that?
So what you're talking about is the primary residence exclusion.
Okay.
So you live in your house for the only requirement to get this exclusion is that you live there for 2 out of the last 5 years.
Okay.
So you move out of your house, you have 3 years to sell it. Otherwise, you're not going to have lived there 2 out of 5.
Wait, you have to be over 55?
No, you don't. No age limit.
Huh.
So 2 out of 5, and you can technically use this every 2 years. You could move houses every 2 years and continually use it. It's not a once in a lifetime benefit either. Every 2 years you can use it essentially.
So you don't have to have owned the house for 5 years. You just like say you buy a house, I move into it for 2 years.
2 years. The rule's 2 years.
2 years. Yeah. That's it.
Mm-hmm.
Oh, okay. And it is $250 for a person filing singly.
Full filing status is single, you get $250,000. If you're married filing jointly, you get $500,000. Yes.
Okay. All right.
Like I have a client who sold their property in Texas. They sold it for $400,000. They've lived here for well over 2 years. I don't even care what they paid for it because the gain's less than $500. I could easily tell her it's tax free. If you sell it for $700,000, you had to have bought it for at least like $200,000 to get that full exclusion, and then that would be tax free.
Can you okay, so if I bought my house for $200,000 and I'm going to sell it, let's say for $1 million, right? So I'm like 700,000. Do you get to write off the improvements you've made to the house, or that is no?
You can include the improvements that you've made to the house as part of your cost basis. So if you bought it for $200,000, but you spent $100,000 improving and remodeling the place, your cost basis is $300,000. So if you sell it for $1 million, you also can deduct closing costs, selling fees, the commissions. You can deduct all of that. So that may leave you with a gain of under $700,000, and $500,000 if you're married would be excluded from taxes. So that leaves you with about $200,000 of a taxable at that point.
Okay. And you don't have to be 55, and there's no limit on how many times you can do this.
Correct. Every 2 years.
Wow. Okay.
There's one exception. If you live in the property for less than 2 years, but you have to move early, or you sell the property before the 2-year mark, if you have, there's a box that we can check to say that if it was due to unforeseen circumstances, which is a change in job, a change in health, or some other type of major change in situation, that you can get a prorated exclusion. So if you only live there for 1 year out of 2, you can get half of the exclusion amount. So if you're single, that's $125,000. If you're married, it'd be $250,000. So there's also an exception for people who move for unforeseen circumstances. So a prorated exclusion. So if you're there for 18 months, you get 75% of the exclusion.
I see. It depends on how long you're there. Okay. All right. All right. So say somebody, because this is actually, this is happening because the prices have tripped up so high, bought their house for $300,000 and now they can sell it, let's say for $2 million. If they sell their $2 million house and they buy another $2 million or plus house, there are no capital gains, right? You're just selling a house, you're buying another one.
That's not true. So the only time that can work is for business property, like rental properties. If you buy a rental property, you can exchange into another rental property. You have to do a 1031 exchange, accommodators, and not touching the money. That's the only tax-free transfer of money. When it's your primary residence, the primary residence exclusion is the only thing you get. You don't get any benefit from reinvesting in another house or anything. There's no tax.
Yeah, there's a lot of people stuck because of that, I feel.
Should be a rule. I feel like when I was growing up, so this was maybe 30 years ago, my dad had sold one house in Huntington and he bought a house in Irvine. And I remember at that time, the rules said you could just transfer it and you didn't have to pay tax, and you pay tax on the back end of the second sale. But somewhere in there, they changed the rules. So as long as I've been practicing, the rules have been, you only get that primary residence exclusion, but there's no exchange privilege.
Yeah, I never really thought about that. I mean, I know a 1031 exchange, but I just, I was hoping you were going to say like, yeah, over 55, but okay, wow. And I mean, and then at capital gain, they're taxed at what their rate is, right? Like 20, depend on where their rate is, right?
Yeah, so if it's a long term, which means you've had it for more than a year, then you can qualify for special capital gains rates for federal purposes. So for IRS, that's either 15% if you're in the lower tax brackets, up to 20% if you're in one of the highest tax brackets.
Okay, all right. This is
on that section, and you also pay state tax. The state doesn't give you any capital gains special rates, not in California.
Yeah, California. Yeah. Okay. All right. Well, thanks. That clears up. Oh, it's amazing how many people are really confused on that. So it's good. I can now talk to people and clear everybody up. I do have one question though, because if you're married and your spouse passes away, is it true that you only get that $500,000 within the first 2 years after the spouse's passing, and then it becomes 250, or is that not true?
In the case of someone passing away, you make it a step up in basis. So if your house is titled correctly, which is either like a joint community property or in a trust, I always recommend putting your house in a trust. Especially in California, you're going to probate if you don't have a trust and your estate's over 150,000. So, you might as well put your house in a trust. Anyway, you get a step up in basis. So if you sell the property very close in proximity to when the death of the other spouse is, you shouldn't pay any tax on it at all, and you wouldn't need to even use the exclusion. Because if you sell it within a year of passing, it's pretty much a wash. You're never going to have a gain in that case.
Gotcha. So that's why people always request the value on date of death. So
I usually recommend people get a broker's opinion if they didn't get an appraisal. Sometimes appraisals are done, sometimes they're not necessary. So a broker's opinion is the next best option to use that for tax purposes.
Yeah, I always wonder about that when people ask for that. I'm like, do they really need to pay for an appraisal? I mean, that's not my end. I am more than happy to do the broker appraisal, but
the broker opinion is good enough, I believe, when it comes to the IRS. If they were to ever audit you and they say, where did you get this number from? Then you have that to back it up. And I think that's sufficient.
All right. Okay. Very good. All right. Trust. When, somebody passes away and it goes to a successor trustee, is there a time period that a trust can live? I mean, and I'm talking when there's a property in it, or does the person who's the successor trustee just always file taxes for that trust going forward?
The trust only needs to file if the trust has income of $600 or more. So if the property is a rental property, and let's say it's still actively being rented, then there is going to be income. So that would be reported on the trust return. Until that property gets transferred to the beneficiaries or gets sold off. If it gets sold off within the trust, then the trust would report the sale. But if everything goes to beneficiaries, sometimes the taxable income portion passes on to the beneficiary. They'll get what they call a K-1 form. So they'll pay tax on any income of the trust. And so the trust can live as long until you empty it out. So if the trust is supposed to stay intact after death for a long period of time, as far as the distribution of assets go, then you may be on the hook to file trust returns for longer. If you get everything out of the trust, put it into the beneficiaries' names, then you can close the trust and you could have zero filing requirements if there was never any income generated on the trust. So it just depends on the nature of the assets in the trust. But the property, if you have a property, that also gets a step up in basis. So whenever someone passes away, there's a step up in basis for the beneficiaries, whether it's a spouse, a child, or a stranger. Everybody will get the step up in basis. So that property, if it's sold within close proximity of the death, like I said again, most likely no gain.
No gain. Right. Okay. All right. I understand that.
It grows in value before you sell it. You only have to pay tax on the value that it's grown since the death. So if you wait a couple years to sell it, you still get the step up in basis, but whatever is above that would be
The delta.
yeah.
Okay. All right. All right. Inheritance tax. California's a state has no inheritance tax. Is that true?
Correct. There's no inheritance tax. The only death tax or estate tax that you need to worry about is if your estate's over 11.5 million, that they keep up in the limit. I can tell you exactly what it is. But I always tell people, if you don't have over $11 million, don't worry about it. There's not going to be any estate filing requirements or estate tax. Heirs never need to pay tax on their inheritance unless you're inheriting pre-tax money. So if you inherit an IRA or a 401k or something like that where the tax hasn't been paid yet, then you are on the hook for the taxes when you take it out. And you have to take those out within a certain period of time. So you have like 10 years to take out money from a retirement account. So they want to collect the tax on that. Don't hold it too long. But if you inherit a bank account or an investment or a property, a house, all of those things get step up in basis. So you don't end up paying tax on those. Same thing with stocks. So the stocks will get a step up in basis on the day of death as well. So if you see those in close proximity, there might not be that much gain either. The same with properties. Property will get a step up in basis. Stocks get a step up in basis. The only things you would have to pay tax on that you inherit would be like a retirement account or potentially an annuity, something like that. Because an annuity is a tax sheltered asset as well.
Okay, man, there's so much for like estate planning. It's just, as you get older, you're like, oh gosh, you gotta really have to start thinking about this stuff.
Inheritance tax, that doesn't exist. There's nothing called inheritance tax.
Yeah, so it's estate tax or other
estate tax if your estate's over 11 million, or it would be tax on your retirement, inherited retirement account, something like that.
And and the heirs to your estate, it doesn't have to be a family member. It's like if you leave yours to a friend, it's an inheritance. That's what it's stupid.
Haven't you seen them leave their estates to dogs and stuff like that? Rich people, they have a cat and they're like, cat's taken care of, anyway, you can leave to a charity, you can leave to person, friends, family, if you don't have any direct family. If you don't have a trust, the state is going to decide who gets your assets. So a trust is the only way to ensure that the right people inherit your assets with your
right. It's
like that you want to disinherit, you can do that through a trust. Like let's say you have a crazy aunt who finds out you die, and now they want to come after you and say, hey, I guess you get a portion of that. I'm a family member. A trust is the only way to ensure that what you want to happen is going to happen.
Okay. Yeah. So yes, if it's not a will, you have to have the trust. People get confused on that. So
right. A will can be contested. A will still has to go to court. A trust is the only thing that'll keep you out of probate, and that cannot be contested.
Okay.
Well, it still can, but in the trust, you can say anybody contest this, then they're disinherited. So they can't contest it. Otherwise, they're going to get cut out if they happen to be a beneficiary. So they do have clauses like that sometimes built in, so to protect it a little bit more.
Okay. That was all for my questions. Is there anything you think you want to share today, or?
I was thinking one of the things you mentioned was about being over 55 and transferring to a new house. I think that might just be a little bit of confusion because they have property tax basis rules in California, like Prop 7, is it Prop 90?
19.
Prop 9. Some of those props that state you can transfer your property tax basis. So if you buy a house that's cheaper than your old house, but your old house had an even lower basis on it, you can transfer that. They have an intra-county one, and they have an intrastate one, I believe. That I'm not an expert on this per se, but if you are over 55, you can transfer your tax basis that way. So if you bought your house for $200,000 and you sell it for $1 million, and then you go and reinvest and you buy another house for $900,000, instead of paying tax as if the property is 900,000, you can transfer your original basis of the 200,000, whatever that's grown to be, because perhaps that's now 300 or whatever, because they grow at 2% a year. So, anyways,
Right, they do grow at 2% a year. Yeah, I've been really drilling down into that Prop 19. It's an interesting one for sure.
So that's a property tax issue. It has nothing to do with income tax. That's
No.
property.
So is there anything over 55 that affects you when you do taxes, or no? That's about it. That's it. Yeah,
It's
nothing.
not a tax side.
Okay.
The
All right.
property. You can do property tax-based transfers, but not like that doesn't affect the income tax.
It's income tax. Yeah.
The question is there IRAs and as a beneficiary, the state has no involvement in this, right? Tax-wise. The state would get money if depending on what your state, if you have state tax and you take out of a retirement account, the state's going to want their piece too. That is true.
Good job, Joe. Thanks. It's good. We can read the questions. I'm pretty excited.
And you also asked earlier about enrolled agents also trained by the IRS. So that enrolled agents are not always trained by the IRS. You can just go and take the enrolled agent exam, which is a 3-part exam. And if you pass all 3 parts, you have it. You get it. You can get the EA. If you work for the IRS, you can achieve your EA by working for them for a period of time. So I think you can, if you work for the IRS for like 5 years, then you automatically get your EA. I don't think they have to take the test. I'm not 100% sure on that route because I just went the testing route. I never worked for the IRS.
All right.
I work for my clients. So that's one thing about our business. We like to work for our clients. We want to save them as much money as possible. We try to know the rules as good as we can so that we can, avoid tax whenever possible or get around or take advantage of whatever we can in the tax code. Because there's a lot of like a wiggle room or they call it loopholes. Some people call them loopholes, but that's because they don't necessarily qualify for them. So they call them loopholes for everyone else who does qualify to take advantage.
Funny way to look at it.
If you don't own a property, then none of the property tax laws matter to you. So of course, if someone who has rental properties are doing 1031 exchange and they never pay tax on their property sales, they're taking advantage of the tax code. Someone else who doesn't have properties might call that a loophole. However, it's just part of the tax code. So we definitely take advantage where we can.
Good. Yeah, I mean, you've been a very good accountant. I highly recommend if you're looking for somebody to, you make it easy and you're very knowledgeable. You always, your stuff. It makes you feel good.
I've been doing this for 16 years, if not my whole life. So like I said, I grew up around it. So even when I was 10 years old, I was doing the data entry for my dad. And when I was a little bit older, I was scanning papers. I would file the files, when I was little, we had paper files before we went digital. And he used to give me the stack of folders for the clients that came in that day. And I'd have to go put them back in alphabetical order in the bookshelf. And then whatever clients were coming in that day, sometimes they'd give me a list and I'd have to go pull the files for those clients. So I remember back in the day when the office was back in Bon Carmen over in Irvine, if you were a client that long ago.
We were, yep, long time ago.
I used to hang around the office, play with staples, highlighters, and paper, and make myself busy as a kid.
Yeah, that's great. Congratulations that that your dad had that business and you enjoy what you do, and you're blessed, right? I mean, yeah.
Yeah, I feel like I definitely got the genes for it, and I really like it, and I enjoy it. I love working with people and giving people good direction. So I'm like a financial doctor, because I remember when I was little, at one point in time I wanted to be a doctor, but I didn't want to work on people that were alive, or I didn't want to see blood. I was scared I might hurt them or something. So my dad's like, well, why don't you want to be a financial doctor? Like, come in like with your money. Like, where does it hurt? Like, how can I help you?
That's awesome. That's awesome. All right, Jacqueline. Well, I was really hoping that I would have all my finances off to you by the time we talk, but I'm so close. I feel so good. Yeah, check. So soon, I'll be there soon. And thanks again. I really appreciate you being here today. Okay, I know it's a super busy time for you guys.
You got me right before we start.
Okay. Yeah, because all the stuff's coming in. Yeah, it's like, yeah, you'll get all my stuff next week. All right, have a good rest of your day, and talk to you soon.
Thank you.
Bye
Bye-bye.
now.